welcome back to another video at the Capital Traders Group. Now, in this video, I'm going to be basically showing you how I made $15,000 trading Ethereum this week using a simple concept that I use time and time again. And I don't only use it in crypto, it works in FX and commodities and etc. So this is a very simple concept, and I'm going to basically be showing you how to utilize it in real-time market environments. So also, if just so you guys are aware, I did share this trade with members. If you guys follow me on Instagram, you would have seen I shared this publicly, the results of this as well. But if I just go on Discord, let's just make this a little smaller. You would have seen, right, full explanation of how and why, the reasoning behind the trade and my thesis, as well as where I am and when I'm entering. So without further ado, let's just jump right into the charts. Okay, so first thing I recommend doing, right, when you're looking at a particular asset, is always go to the weekly or the monthly time frame and map out your ranges. Right now, this is especially true for for crypto, is because you need to understand where price is deviating or liquidating from. So if you look at Ethereum highs, you see it wicked out the high, right, deviated below, and then expanded to the downside. Okay, then you can see the same sort of scenario happen to the lows. Wick out the lows, deviate, and then expands to the upside. Now we're in the midsection. Okay, so now we're in basically the equilibrium of the range, right? So price is either going to break above this range and then expand back to the upside, okay, or it's going to retest this range and then start to deviate again before retesting the lows. Okay, so there's two probabilities, but you need to be aware of the levels which you should be looking at these potential scenarios to play out from, right? Hence why we map out these ranges. So now let's move down to the daily time frame. So if you look on the daily time frame, what do you exactly see? Right, let me go on a 3-day to make this, illustrate this a little better. Right, what do we see on the daily time frame? If you look on the left, right. If you look on the left, what do we see? First thing, we see an impulse, right, to the equilibrium, then a slow pullback, and then we see a second impulse. Okay, so now after you see an impulse, what do you anticipate after an impulse? Some sort of correction, right? So if price is to stay true to this current trend, we're likely going to see some sort of impulse again, right, in price. So we have an impulse, correction, second impulse. Now we're in the correction phase before I'm anticipating another impulse to take place. Okay, to either test the highs of this equilibrium range again, or just to come back above. Okay, to see a clean break above. And if that is the case, then we know that we'll start looking for corrections to start looking for a third impulse in price, if that makes sense. Okay, right, so now we know those two scenarios. Now what I want to do is start building a bias. Okay, so now I've explained where we had the impulse, the second impulse, and we have potentially another correction before a potential third impulse to potentially take out these highs here. Okay, so let me go down on the daily time frame. Okay, now if we look on the daily time frame, what do you exactly see? Okay, so we had this demand level here, which price respected. So this is the zone that took out this liquidity, this low here. Okay, so you want to pay attention to that. Why? Is because this was the last low that took out that low, that led to an impulsive push in the market. Okay, we saw expansive push in the market about 100%, which means there's strong buyers in this level. And if you look here to the right, you would have seen that was correct. We had the impulse, the correction, price reacted from this level before we saw another impulse, right, which led to, I think, another 100% push in the market. Okay, so where would be the next zone I want to be looking potential buys from? Okay, if we are going to see that second impulse, it'd be this zone. Now the reason why, again, you should probably already see this, is because this was the last zone that took out a prominent low that led to a breaker structure. Okay, it led to a breaker structure of the high. So it's a prominent demand zone you want to be keeping an eye on. So it was a last low that was swept that led to a breaker structure. So it's a prominent zone that manipulation was purposely engineered into the market for institutions to enter their orders at a much discount level before ascending price above and breaking prominent structure. Okay, because look, you got to remember, retail are not buying at these levels. Think about this low to the left. Okay, think about all the stop losses that were left just below this low, and all that liquidity that was hunted before the real move was made. Okay, that's why this is a prominent demand zone. Right, so now we understand prices at a daily demand level. Now what we want to be doing is looking for potential reversal signs on the lower time frame. So we understand that we're in a potential sort of corrective structure level. So price is likely going to give us a second impulse, but we need more confirmation for that bias to even be valid, right? Just because we're at a demand level does not mean we should just randomly be buying. Okay, so one thing you'll notice is we've seen one, two, three drives. Now if you haven't seen my previous video about this, I recommend you go watch it. It's called the 3 drive strategy, but it's basically when you see 3 drives into a particular level, right, before you see expansion. Okay, this works with accumulation or distribution, but it's a simplified Wyckoff strategy that I implement when I use when I trade. Okay, it's very simple, but it's in essence when you see 3 drives into a particular demand levels, and the way the thesis behind this strategy is basically because institutions want to be buying at lower and lower levels, so they want to be buying at deeper discounted levels, also at the detriment as retail by collecting all retail stop losses and also getting deeper liquidity to fill their orders with before you see expansion in price. Right, this works with both at demand levels or supply levels, but this is the first thing you notice when you look at this. Now the second thing you would notice if I push down on the 4 hour is price, right, after we saw that expansive push to the downside, right, we saw that expansive push to the downside of this daily candle, what you'll see is we have this big wick. Okay, now for those who don't know, when you have big wicks like this, right, when you have big wicks like this, they always get filled, always, right? So what I'll do is map out this wick. Let's map it out gray. So I'll map out this wick, and then what you'll look on the right is you'll see it slowly gets filled. So then what all I'll do is just refine the wick even further, okay, from the part of the wick that's not filled, right? Because this is, on the lower time frame, this is what you refer as imbalance or price inefficiency, and price inefficiency always gets filled. Again, I made another video about this. I recommend you go watch that as well. But if you look on the right, what does price do, right? It wicks out, it takes out that low, okay, it takes out that low, deviates, and then makes a push to the upside, okay, finally filling up. The majority of this wick has now been filled, okay, and what you'll also notice is we have another 1, 2, 3 drives, okay, so we have another 3 drives within a 3 drives pattern on the daily, which makes this a lot more bullish. Okay, because we're at a 12-hour demand, we have 3 drives on the daily, okay, and then we have another 3 drives once the previous bearish imbalance has now been filled. Okay, and if you look closer, you would have also seen is we have a breaker structure above as well. Okay, so we have a BOS of the previous high, then price comes down, gives us the 3rd drive. So now this is increasing the probability of price to actually come up into at least to our equilibrium level. Okay, so where would I want to be looking for potential supply levels from, right? You're probably wondering. Now the zone where I'll be looking for is from here. Now if you're wondering why, all you have to do is investigate and look a little closer in price, and you'll notice is we have another 1, 2, 3. So you have another 3 drives pattern, and you also have a wick of the previous high. Okay, so that's what I refer to as inducement. It wicks out the high, and then it makes the impulsive push to the downside. Okay, so we basically have the imbalance fill, 3 drives. Now is where our bias is now building. Okay, so now this is where we actually go on the lower time frame and look for lower time frame confirmation. This is where my actual model or concept comes into play. So what you see here, right, is after you see that 3rd drive, now I want to be looking for intent for price to push higher. Price needs a reason for it to push higher, right? I.e. it needs to hunt liquidity. So in order for price to push into one direction of the market, it needs to hunt liquidity from the other, if that makes sense. Okay, so if we look here close enough, you'll see we have these relative equal highs. Okay, so we have liquidity to actually target. Okay, so there is intent for price to actually push up higher, right? And we also have a bearish order block, right, with, let me go on the daily, with imbalance above as well. So we have imbalance here that needs to get filled, okay, because price did not fully fill all this imbalance here to the left. So we have intent for price to push higher also. Okay, so now let's push down to the actual lower time frames. Let's push down to the 1 hour. Okay, so now we have the 3 drives. Now what I'm looking for is what price is actually looking to do. So liquidity above is the target. Let's go on 2 hour. Now I don't want to be blindly looking to enter at this level, but if you look to the left, you would have seen we had a raid of liquidity, these relative equal lows, right? Price takes that zone out and then makes an impulsive push to the upside, right? So my next zone of reference, or my point of interest, would be from here. Full zone would be here, but I'm going to be refining this zone down. Okay, if we go to the 1 hour, we can refine it even further. Okay, to around about here. Okay, now this is a zone where I can be looking for potential longs from. Now I wouldn't be blindly just placing a limit order here, right? That's not really how I like to trade. I like to wait for lower time frame confirmations for price to enter. But basically what we've seen is an impulse, right? Just like on the lower time frames, we've seen an impulse. Now, after you see an impulse, what do you expect? A correction, right? So I want to see this correction play, right? See some sort of slow momentum before the second impulse, right? Because we can sort of see this potential basically cup and handle pattern play. For those who don't know what that is, that's not really a pattern I like to use, but you do see it play out. It's a very old pattern, but you do see it play out on crypto every now and again. But it's Google it, but it's basically you have a cup and then you have a handle. You have an impulse like that, and then a correction before the second impulse continues. So what you'll notice is price is very fractal. What happens on the higher time frames, same thing replicates on the extremities of the lower time frames. So to the week, to the daily, the weekly, the monthly, to the 1 hour, 15, 1 minute, etc. Okay. So basically, what I'll be looking for now is to see how this correction level plays. So price comes into our level again. No entry taken at this level, because I want to see what price is doing. But if we look here, we've basically swept all these lows. We've taken out all these lows, right? Now, in order for me to be interested in longs, we need to take out this high. Okay? So let's see what price does. And that's exactly what price does, okay? So we basically took out the previous low, and then we took out the previous high. Now this is a model that I use time and time again. Now I've used this model on I made a previous video on a trade recap I did on gold. Okay, I use the same model. So now I understand that price has now mitigated or came into my level, okay, and taken care and filled in the imbalance of that demand level, okay, and also has taken care of both sides of the range. So it's basically liquidated both buyers and sellers, fucked them off, hunted the stop losses. Now it's going to make its real expansive push, okay. So now what I'll be doing is pushing down to the 15-minute and actually mapping out my zone. So the two zones where I'll be looking or want to be looking for entries from is this level, demand level 1, okay, and then let's push on to the 5-minute and let's see what price is doing here. This is my main level because we have imbalance all above here, so I'll refine this level slightly, right, to fill in that imbalance. Now if I push to the 5-minute, there's also another zone that I like, which is just that led to this breaker structure, which is this level here, okay. Now if I push on the 1-minute, this is actually where I end up taking entry. Now main reason for this was because we had the breaker structure now, right, which confirms intent for price to push up higher, but you would also see we've had these clean equal lows, okay. So you have clean liquidity, and after liquidity is swept, right, so what you'll notice in this model is when you see liquidity or relative equal lows or highs swept, right, you'll see an expansion of the other side of the market. So understanding that this is where I was looking for actual longs, right? Because mainly because you see sort of this order flow building, right? You have a buying level, price breaks structure internally, right, and then comes back to that level again, and then breaks structure again, and then comes back to this level, right, to then potentially break structure again, okay, to then target external liquidity here. Right, BOS. So on the high time frames, we have a neutralized model, right, which is basically when you have a range, right. This is a model that I've been using for years. You have a range, low gets swept, high gets swept, and then you see expansion of the high. So whichever the next higher high or higher low is where price will expand into, okay. So this is exactly what I'm doing, but I'm mixing it with lower time frame confirmation. So with the order flow and liquidity raid, right, I took my longs around about here. Okay, let me push up to the 1 hour time frame now. Okay, now where would I look to target? Now my first target, right, for my entry here, my first target would obviously be those relative equal highs, because I understand that price is going to hunt that liquidity. Now where would my second target be? My second target would be the imbalance, to fill in the imbalance, right, which is at the $1,800 region, okay. Now my stops were bigger, mainly because when I entered here, I just wanted to be sure that because there was imbalance left below, right, just in case price wicked down, okay, I didn't want to get stopped out just to fill in that imbalance before it pushed up. So I did have two setups. One, so the way I trade is I put 0.5% risk with my tire SL, and then I put 1% risk with my inflated SL, just because it allows me to risk a little bit more and be lets me swing my position a bit more comfortably. But if we see how price plays, right, price just straight up expands from there. We had the impulse, right, but again, what do you see after the impulse? Impulse, correction, right. Again, even if you miss this move, liquidity is still intact. You still would have been able to enter once that imbalance was filled, and then you would have seen that second impulse, right, and then now liquidity is taken, so to take up partials at this level and wait to see if price gives some sort of corrective structure to then long again, of which, if we be patient, it doesn't come down that far, okay. But let's see what price does. it continues up expanding and comes into my target. Okay, so this played around about 11R, I believe. I took profit just above the high there, so it was roughly about 11R. I'll show you guys that momentarily as well. I shared it with Discord and premium analysis members, but yeah, so I just want to show you guys a simple video, or a bit of a trade recap of me doing top-down analysis and actually showing you guys how I utilize these concepts in real time. And I'll leave a screenshot of my entry and exit as well. But if you guys enjoyed this video, please do like and subscribe. It's very much appreciated, and I'll see you guys on the next one. Bye bye.